Hey, what's up? I'm Tiessen with Hubbell Real Estate, and today I'm bringing you a Santa Maria Valley market update, recovery numbers for the month of October. But before we jump into that, as you guys know, if you watch my videos, I usually give a tip at the end of the video in the real estate investing world. But today I'm actually gonna do two. So we're gonna talk about a term that's very important if you're a real estate investor. And then we're also gonna talk about the best time to sell your house to get the most bang for your buck, the most money for your house. So jumping right into the numbers, this month on active listings, we did see another decline down to 114 active listings. So if you remember last month, it was up in the 120s. So a slight decrease again this month. Sold listings were at 111, basically even. Last month we had 113. So everything's looking pretty much like the market's just humming along just as it was in previous months. We did see new listings coming on the market increase up to 125. Last month we were down at about 110, so that is a nice increase. We're seeing more inventory coming on the market, but unfortunately we still barely have anything on the market. We still are just at 5 weeks of inventory on the market. So for sellers, this is very good. It gives you the advantage as far as pricing goes, as far as the terms go when negotiating contracts. The average price, we did see a huge increase compared to October of last year. We saw a 20.5% increase, so up to $495,000 on average last month. We saw our days on market stay about the same, 10 days. Last month it was 9. So basically same thing, houses are going really quick, selling really fast because of such low inventory. Year-to-date price change, again, very similar, we're at 12%. So that's a very good return on your investment, guys. Stock market averages historically over time about 8%. So a 10 to 12% on real estate is a very good return on your investment. Speaking of returns on your investment, let's talk about the extra tips I talked about. The first thing I want to mention is the best time to sell your house. Now, conventional wisdom says the best time to sell your house would be spring to early summer. That's when you see the bulk of house selling going on. And a lot of people think that that is going to be the best time to get the most money for their house because that's when everybody's looking. But if we go back to just basic economics, and you guys remember we have supply and demand on our chart, right? And what happens is the market finds an equilibrium, right, between the supply and the demand. However, if we see demand raise, say hypothetically we have historic low interest rates, that's gonna raise demand, right? And at the same time we see very low supply, which is what we have right now, that's gonna shift those lines a little bit. And what that's going to do is create a shortage of inventory. So as we come into the winter months and there's less homes for sale on the market, we see more of a shortage. When there's less sale, what do we know? When there's less for sale, what do we know? We know that you have less competition. That allows you as a seller to push up the price of your house a little bit. So if you're considering selling the next 6 months to a year, I'd really consider putting your house on the market in the winter time when there's less competition and you can drive those prices up even more as a seller. The next thing I want to talk about real quick is an investing term for real estate. And it's more for commercial or if you're doing multifamily, but that term is called the cap rate. And what we look at with the cap rate is the capitalization rate on your money. So the way you find that is you take the net operating income, so all of your income from your rental properties minus your expenses, you take that net operating income and then you divide it by the percentage you want to get. So let's say you get $50,000 net income for your house and you want to get a 10% return on that money. If you were looking to buy that property, you would look to purchase that at $500,000. Does that make sense? If you were looking to get a 7.5% return on your money, again, still $50,000 worth of income, you're looking to purchase that property around $700,000, right? So the way that we see cap rate utilized is investors will look at this to determine how badly they want to get a property. Typically speaking, if a property is in worse condition, if it's higher risk, they're going to want to see more return on their money, right? They're going to want to see 10%, maybe an 11% if it's a really bad property. The safer the risk or the less risk there is, the lower return you're going to get on your money. So you've got a brand new building, it doesn't need repairs, tenants are good, they're going to be long-term tenants. You might get a 4% return, a 4% cap rate. So you're going to pay a little bit more for that property, but the returns are generally thought of as more guaranteed. So That's it for today. Hope you guys found that useful. We talked about cap rate, we talked about the best time to sell your house, and of course we talked about the market update, the stats for the month of October. If you guys have any questions, again, my name is Christian Tiessen. I'm with Hubbell Real Estate. My number is 805-459-9834. Talk to you guys soon.